Hello and welcome to the second part of IND AS 12 income taxes. So as we promised that we have split this entire IND AS into two parts. In part one, we covered the conceptualization of IND AS 12. We also showcased a few examples whereby we could able to bring clarity on some of the key definition regarding the current tax, deferred tax, both deferred tax liability, deferred tax asset, temporary difference, and other related definition that were required to ensure that we can clearly understand the concept of IND AS 12. And we also promise that we are going to come up with the detailed presentation on the various examples so that we could able to clearly articulate how this IND AS 12 help in the accounting of the income taxes. So we are here again to cover those examples. So what we are going to cover today as a part of this session, we are going to have a quick look about how DTL is created in the books. We'll take an example of depreciation. We'll also look at again the how DTA is created in the books. We are going to take the example of depreciation. So we are going to take the asset side of it, which is like PPE, to illustrate how DTL and DTA is created in the asset side. Then we are also going to look at how DTA is created in the liability side, which is the warranty provision. And then we are going to see the DTA reversal of the warranty provision. We are going to cover two specific cases on the carry forward of losses. First, where we have the opening DTA available, and second, where we do not have any DTA available. And we are also going to cover one more case, which is like change in the tax rate, which is the DTL reversal. So with these seven cases, we are going to cover the entire concept of deferred tax asset and deferred tax liability. And this is largely going to be a kind of a full end-to-end, learning and refreshing refresher of the IND AS 12. So we'll start with the first example. We'll move to the first slide. Moving then. Okay, so we are here with the first example or DTL on with the help of the depreciation. So before actually jumping into the example, I just quickly want to emphasize on the key rule, thumb rule. So you can see a thumb here. So we are talking about the thumb rule here. So we have classified into the assets and liabilities, and then we are uh, just giving a kind of a quick cheat sheet so that when one could clearly understand that when is the DTA is going to created, when is the DTL going to be created. So if we are talking about an a particular element in the asset side and wherein book base is more than the tax base, it is taxable temporary difference. So on taxable temporary difference, we have to create DTL. But if my tax base is more than books base, then it is a deductible temporary difference on which we have to create DTA. So this is a thumb rule on the asset side. On the liability side, if my tax base is more than the book base, then taxable temporary difference, which is DTL, and my book base is more than tax base, then it is a deductible temporary difference in. This is like thumb rule when we are talking about the creation of the DTA and DTL. So we are clear when we are creating the DTA and DTL. So ultimately, when we are creating the DTL, the objective is that we are assuming that, not assuming that, in fact, the basis the current scenario, it is being known to us that we have paid less tax in the current year, and hence we have the liability to pay larger taxes in the future year, and hence we create the DTL. And it's a reverse in the case of DTA. So in DTA, we are paying less tax. We are paying more tax in the current year, and hence we are creating an asset which can be utilized whenever there is a probable profit in the future. So this is a key difference between the DTL and DTA. In DTL, we have paid less liability today, but less liability in the current year, but we have to pay more liability in the future. Hence, we have to create the DTL. But in DTA, we have paid more taxes today, and then definitely when we are paying more taxes today, we are creating an asset in the books of accounts, and hence when we are creating the asset, its recoverability depend upon the future profits. If it is probable that future profits will arise, then only we could able to recognize that DTA in the books of account. Otherwise, we cannot. So this is a thumb rule. So with this understanding, we'll quickly start the first example. So scenario is that we have an asset which is the cost of 1 lakh rupees. Depreciation rate as per the books is 10% straight line method. Depreciation as per the income tax is 25%. This is largely WDV. Profit before depreciation and taxes is taken as 1 lakh rupees, and tax rate is assumed as 30%. So our first step is that we have to first calculate the current tax. So current tax, as we know that, and we discussed in the part one, that current tax is the tax on my taxable profit, and it is being calculated at the rate which is relevant at the time of my reporting date. So computable taxable profit is my 1 lakh is my profit before depreciation and tax. And for current tax purpose, we have to deduct the depreciation as per the Income Tax Act, which is 25,000, which is 25% of my 1 lakh. So which is 25,000. So my profit before tax is 75,000. My current tax is on 75,000. I have to create 30% provision for my current tax, which is like 22,500. This is the step one. On step two, what we have to do, we have to calculate the tax base and the book base. So we have to calculate the tax base. So my carrying amount of the asset as per the tax base is 1 lakh, which is as per the opening initial recognition in the books of account, less depreciation as per the income tax, which is 25,000, which is being used and deducted in the to get the taxable profit. And my tax base is 75,000. My book base is 1 lakh as the carrying amount, but my depreciation as per books is 10% on the straight line method, which is 1 lakh. On 1 lakh, it's like 10,000. 10% of 1 lakh is 10,000. So I'm deducting 10,000 of depreciation. So my book base is 90,000. So my tax base is 75,000. My book base is 90,000. So which means my book base is more than my tax base, which means my first rule will apply. And we have to calculate the temporary difference. And this is taxable temporary difference, because this is my book base is greater than tax base, and this is a DTL creation. So wherein my book base is 90,000, my tax base is 75,000, my temporary difference is 15,000. Now we have to go by the rule. So we are saying that book base is greater than tax base. Asset side is a taxable temporary difference. So DTL will be created. So on 15,000, what we are going to do? We are going to create the DTL at the rate of the prevailing tax. We are going to create the 30% of 15,000, which is my 45,000. So this is my DTL which is being created. Now we have to calculate the total tax expense. So if you recall, when we're talking about the tax expense is the summation of the current tax plus or minus the DTL or the DTA that has been created. So which means that in this case, because my DTL is there, so which means that this would be added to my current tax, because what is happening, I am paying less tax in the current year, but I have to pay more tax in the future year, because my book base is going to be reduced and my tax base is going to be on the higher side in the future year. When this has happened, then definitely I'm going to utilize this DTL at that point in time. So in this case, my current tax is 22,500. My deferred tax liability is 4,500. My total tax expense is 27. So I have to pay charge to my PNL will be 27,000, but the provision for tax would only be 22,500, because this is the amount which we are going to pay to the income tax authority. Though I am creating a separate deferred tax liability in the books of accounts, which is like 4,500. So we have to create an entry. So we are debiting the PNL with 25,000, 27,000. Then we are creating the provision for tax with 22,500, and we are creating one more deferred tax liability, which will be shown in the non-current liability in my balance sheet for 4,500. This is a typical example wherein we are creating the DTL. We'll move to the next slide to quickly have a look at the presentation in the financial statements. Okay, so we'll quickly have a look at how these facts are going to be presented in the financial statement. So my profit before tax is 90,000, tax expenses 22,500 plus 4,500. So my tax expense will be 27,000. My profit after tax would be 63,000. This is how it is going to present in my P&L. And the balance sheet, we have to create the provision for tax, which is 22,500, which is current liability. We have to create the non-current deferred tax liability of 4,500. And then we have to create on the asset side, there's a PPE, which is the carrying amount of the asset as per the book, which is like 90,000. So key points: current tax 28,500, temporary difference, which is the difference between the book base and tax base, 15,000, tax expense, which is sum of the DTL plus current tax, which is like 27,000. DTL is the tax percentage on my temporary difference, which is 15,000, and 30% of it is 4,500, and the carrying amount which is shown in the balance sheet is 9,000. So this is the example wherein we have shown that how DTL is created for a particular entry in my asset side. Now we'll move to the next example to see how DTA is created on the asset side. Okay, so now we'll touch base on the creation of the DTA on the asset side. So we have just twisted this scenario. So the cost of the asset is again 1 lakh rupees. Depreciation rate as per the book is 10%. But now we have taken less depreciation as per the income tax, which is 5%. So profit before tax again the same 1 lakh rupees. And then a tax rate is again assumed as 30%. So now we'll again do the step one, which is computation of taxable profit. My taxable profit is 1 lakh. Income tax depreciation is 5% of my 1 lakh, which is 5,000. Profit before tax is 95,000. Current tax is 30% of 95,000, which is 28,500. Second step, we have to do the book-based calculation and tax-based calculation. So my tax base is 1 lakh, the carrying amount of the asset, 5,000, which is the depreciation. So my tax base is 95,000, but my book base is more, which is 1 lakh minus 10,000, which is less now, because my tax base is 95,000, my book base is 90,000. So which means that this is a situation of second scenario where my tax base is more than a book base. So which means that we have to create a deductible temporary, we have to create DTA because this temporary difference is deductible. So then what we have to do, we have to calculate the temporary difference. My book base is 90,000, tax base is 95,000. So my temporary difference is negative 5,000 in this case, or TB is more than my BB. Now we have to again do the calculation of temporary difference, which is the tax rate multiplied by the temporary difference. So my tax base is more than book base on asset side, hence deductible temporary difference. So we have to create the DTA on the deductible temporary difference, which is 30% of 5,000, which is 1,500. So my total tax expenses, my current tax, which is like 28,500, and then my deferred tax liability, which would be minus 1,500 in this case. So my total tax expense is 27,000 here. So which means that my tax expense is 27,000. My current tax liability is 28,500 because I have to pay more tax in this scenario, because my depreciation is less and hence I have to pay more tax now. So when I'm paying more tax in my current year, then I have to create the DTA. So we have to create the DTA in this case, deferred tax asset. So if we look at the entry, so we have the two entry. So we have to create the first entry for profit and loss to provision for taxation, which is for the amount of my current tax, which is 28,500. And then second entry is my, we have to create the deferred tax asset to my PNL, which is to the extent of 1,500, which is the amount for which we have created the DTA. Now we'll quickly go to the next slide to see the presentation in the financial statement. Okay, so we'll quickly have a look at the presentation in the financial statement. So profit before tax is 90,000 because 1 lakh minus the book depreciation, which is 10,000. Tax expenses 27,000, which is a summation of 28,500, which is my current tax, and minus 1,500, which is my deferred tax asset. And then we have total profit after tax is 63,000. So in my books, what's going to happen? We have to create the provision for my current tax, which is like 20,500. We have to create under non-current assets a deferred tax of 1,500, and then we have to also create a 90,000, which is my carrying amount of my asset in my books. So key points: current tax 28,500, temporary difference which is deductible 5,000, tax expense 27,000, which is the sum of 28,500 minus 1,500, which is my deferred tax asset, and my carrying amount is 90,000. So with this example we cover the two scenarios. One is creation of the DTL on the asset side, and second is the creation of the DTA on the asset side. We have taken example of PPE and the depreciation. Now we'll move to the next example. Okay, so now we'll come to the third example. What we are saying, warranty provision on warranty provision, which means that it's a example of DTA. And why it is DTA, we'll quickly have a look at the example. So we are saying that we have to create the provision of warranty, which is 50,000. Tax law allowed only on the payment, so which means that we can only deduct the amount from my taxable profits once we have paid that amount on account of this provision. My profit before this provision is 1 lakh rupees and tax rate is again assumed at 30%. So we have to first calculate my current tax. So my profit before depreciation and tax is 1 lakh. My PBT is 1 lakh because I cannot deduct this 50,000 from my taxable profits. So which means that my PBT would be 1 lakh only, and then I have to create the provision of current tax, which is like 30,000. So step two, we'll come to the step two, wherein we are going to compare the tax base and book base. So we do not have any tax base here because we are taking that amount as zero. But we have a book base because we have created a provision, which is like 50,000. So this is a case wherein my book base is more than my tax base, which is my liability side, and hence we have to create a temporary difference on which we have to create the deferred tax asset. So calculate the temporary difference. So my book base is 50,000, tax base is 0, my temporary difference is 50,000. We have to determine whether this is taxable deductible. Now because my book base is greater than my tax base and this is a liability side, hence we have to create the DTA. So what we'll do, we'll create the DTA on 30% on 50,000, which is like 15,000. So this is the amount of DTA that will be carried in my books of accounts. Now my total tax expense would be my current tax, which is 30,000, and we have to deduct the deferred tax asset, which is like 15,000. So my total tax expense would be 15,000. So what will be the entries? So we have to create two entries again here again. First is my P&L debit to my provision for taxation, which is to the extent of 30,000 rupees, which is my current tax. And second, we have to create one more entry of deferred tax asset to my P&L, which is on account of the 15,000 for which we have created the. Now we'll quickly go to the next slide and see the impact on my financial statements. Okay. So on my financial statement, what will be the impact? My P&L is 1 lakh rupees. My tax expense, which is the summation of 30,000 of my current tax and DTA creation is 15,000. So my current tax is 15,000. My profit after tax is 85,000. In my balance sheet, how we are going to show my current tax liability is 30,000. My provision for warranty would be 50,000. And in the non-current asset, we have one 50,000. So key points: current tax 30,000, temporary difference 50,000, which is there because of account of provision for warranties. Then we have the tax expense 50,000, which is the 30,000 of the current tax minus 15,000 of the DTA. DTA is 15,000, which is 30% of my temporary difference, which is deductible temporary difference of 50,000. And then we have a warranty provision of 50,000. Now we'll go to the next example and see that once this warranty provision is actually paid, then what will be the treatment in the next year. Okay, now we'll quickly cover a scenario wherein, with respect to the previous example, wherein we created the provision. Now, what we are saying that out of that provision, we have actually paid an amount of warranty. So, what we are saying that we have made the payment of 30,000 as a claim towards the customer's warranty claim, and then we have a profit before tax and depreciation is 1 lakh. Now, assuming that again the same scenario, we have 1 lakh now, with respect to the taxable profit, since we have actually made the payment, so this expense is now become allowable in my income tax. So, as per the income tax, my total deduction is 30,000. My profit before tax is 70,000, and then I have to pay 21,000 as my current tax. So, this is the current tax liability that we have to pay. Now we'll quickly come to the second step of calculation, tax base and book base. Now tax base is again zero because whatever amount we were supposed to absorb, we have already absorbed that amount. We have reduced that amount from my profits and there is no zero. So there is no amount of amount that we are carrying in the tax base. However, book base is reduced to 20,000. So earlier it was 50,000. Now since we have paid 30,000 out of it, so my provision balance is 20,000. So we'll come to the again calculate the temporary difference. Now my book base, again this is the same scenario. My book base is more than my tax base, which means that it is a DTA. So we have to create the DTA on 20,000. But we already have created the DTA on 50,000 in the last year, which is on account of 15,000. So this would be a scenario wherein we are already carrying a DTA of 6,000. So which means that our DTA, which was 15,000 earlier, that will be now be restored to 30% of my 20,000, which is 6,000. So which means that there is a scenario wherein we have to do the DTA reversal in this case. So this is a DTA reversal scenario here. because we already have an opening DTA of 15,000 and our closing DTA should be 6,000. So hence we have a scenario wherein we have to reverse our DTA to the extent of 9,000 because we are actually utilizing this amount in the next year for paying the taxes. So my current tax is 21,000. My deferred tax asset is 9,000, which is a reversal of the deferred tax in this case, and hence my total tax expense is 30,000. So again, we have to create two entry here. My PNL would be debited and my provision for taxation would be credited for 21,000. Then we have to create one more entry. My PNL would be debited by 9,000 and my DTA would be reversed to the extent of 9,000. So we'll quickly go to the next slide and see the impact of this in my financial statements. Okay, now in this slide, we have profit before tax, which is 1 lakh rupees. Tax expense is 30,000, which is a summation of two element 21,000 of my current tax and the DTA reversal of 9,000. My profit after tax is 70,000. In my balance sheet, we have to create the provision for my current tax, which is 21,000. My provision for warranty, which was 50,000, reduced to 20,000 now. And then we have non-current deferred tax, which was earlier 15,000. Now it has reduced to 6,000. Now my current tax is 21,000. My temporary difference is 30,000, tax expense 30,000, ETA reversal 9,000, and warranty provision reduced to 20,000. So we'll go to the next slide and look at the treatment of carry forward of losses when we already have an opening DTA. Okay, now we'll look at an example wherein we have a unabsorbed or carry forward losses from the last year, but we also have the opening DTA being created. Now we know that we can only create the or recognize the DTA if we have the probability that we are going to have the profit. So I think because we already have the profit, so which means that the in the last year when the assessment was done, the DTA got created on the losses that were that were there in my last financial year. Now, in this scenario, we are saying that my profit before tax is 1 lakh rupees. My bought forward business loss is 20,000. DTA was already created on that. Assuming that 30% is the tax rate, and then my future taxable profit, we have to DTA can be recognized. So, which means that we are probable that we are going to have the future profits. So, my profit before tax is 1 lakh. We are going to calculate the current tax first. My less bought forward losses because these are allowed in my income tax. My profit before tax is 80,000. My current tax is 24,000. So I have to pay 24,000 as a current tax liability for this year. Now, DT on the bought forward losses was already created in my last financial year. I'm carrying this because at that point in time, my tax base was more than my book base, and hence we could able to carry that DTA in my books of account because my unabsorbed losses was only there in my tax base and it was not there in my book base. But my total tax expense for this year would be my total tax current tax, which is 24,000. Now because we already have 6,000 and we have actually utilized that losses, we have absorbed that losses in my books of account in my taxable profit, sorry. So when we are absorbed that losses in my taxable profit, which means that I'm actually consuming the equivalent DTA on the same while calculating my total tax expense. So my total tax expense, which is 30,000, that will be adjusted through the DTA reversal of 6,000. So my current tax would be 24,000. My adjustment, which is DTA reversal, would be 6,000, and my total tax expense would be 30,000. So my accounting entries would be my PNL would be charged on the basis of 24,000, which is my current tax. My PNL will again be charged because now this charge is not on account of any liability, but it is the reversal of my deferred tax. So one important point which needs to be kept in mind is that the charge to the PNL is 30,000 and it has not been reduced because of this loss because my reduction in the PNL had happened in the last year when I had created the DTA on the losses, because when I created the DTA on the losses, then I had credited my PNL last year. So which means that the effect to my PNL has already been done in the last year. Now we cannot again give the same effect here. So we have to give a neutralizing effect here by creating the debit in my PNL and crediting my DTA which was created last year. So in the financial statement, how it's going to present, my profit before tax is 1 lakh. My tax expense is which is summation of 24,000 plus my DTA reversal, which is 6,000. So my total tax expense 30,000. My profit after tax would be shown as 70,000. In my current liability, my provision for tax would be reflected in 24,000, and in the asset side, my non-current asset deferred tax would be shown as a zero because I have utilized the entire DTA on my losses in this financial year. So this is an example when we have a brought forward losses, but we also have the corresponding DTA being created on that. Now we'll go to the next example. We're in similar scenario, but we do not have an opening DTA. Okay. So now we are talking about a same example, but with the fact that we do not have the opening DTA. So we have 1 lakh the profit, 20,000 as the brought forward losses, but DTA is not there. And we are probable that we are going to have the future profit, so we can recognize the DTA. Now in this situation, we already have 1 lakh as a profit. We have brought forward losses 20,000, and then we have a PBT, and then we have created the 30% of 28,000, which is 24,000. Most important thing that is to be kept in mind here is that since we have absorbed, we have fully utilized the losses, hence there is no requirement to create DTA in this case because there is no benefit that we are going to use in the future years because we have already consumed the entire benefit this year itself. So there is no DTA that is required here. My current tax is equal to my 24,000, which is also equal to my tax expense before because there's no DTA recognition that is required. So I'll pass my entry as P&L to provision for taxation. In my financial statements, 1 lakh is my profit, 24,000 is my current tax, or that tax expense is also equal to 24,000, and my profit after tax is 76,000. This is a typical scenario when my effective tax rate is actually less than my income tax rate because my income tax rate is 30%, which is 80,000, 24,000 of 80,000, but my ETR, which is effective tax rate, is less because I have paid less taxes because I have utilized my losses from the last year in this year. So my provision for tax will be shown in the balance sheet for 24,000 and my deferred tax asset will be shown as 0. So we'll now move to the last example and talk about the impact of rate changes and how it is going to impact the creation of the DTL and the reversal. Okay, so now we are going to talk about what is the impact of rate change. So we have taken one example here, and then we are going to share it in 2 years. So we are first showing in the year one. So in the year one, what are the facts? My cost of an asset is 1 lakh rupees. Depreciation as per the book, which is India's is 20% state line method. Depreciation as per the income tax is 40%, which is WDV. Profit before depreciation and taxes is 1 lakh. Tax rate assume 30% in the year one. It is 25% in the year two. So we'll quickly go to the steps then. So first step is calculation of my current tax. So my PBDT is 1 lakh. My income tax is 40% of 1 lakh, which is 40,000. My PBT is 60,000, and hence my current tax is 30% of 60,000, which is 18,000 rupees. Step 2 is calculate the tax base and book base. So tax base is the of carrying amount initial recognition minus the tax depreciation, which is 40,000. My tax base is 60,000. My book base is 1 lakh minus 20,000 because my state depreciation is 20% SLM. So 20% of 1 lakh is 20,000. So my book base is 80,000. So my book base is more than my tax base. So this is a scenario of my DTL creation. So I'll create the DTL on 20,000 minus 60,000, which is 20,000. So my book base is more than tax base, and hence is a temporary difference. Hence we'll create a DTL. So my DTL would be 30% of 20,000, which is 6,000. So my step 5 is the calculation of my total tax expense. So which is my current tax, which is 18,000 plus DTL, which is my 6,000. So my total tax expense is 24,000. So we'll move to the next slide to see the impact on my financial statements. Okay, now we'll quickly show the impact of the transaction in the financial statements. So my profit before tax is 80,000, which is 1 lakh, which is PBDT minus depreciation as per the books, which is 20,000 because my depreciation as per the books is 20% SLM, which is 20,000. So 1 lakh minus 20,000, 80,000. My total tax expense is 24,000, which comprises of two components, 18,000 as my current tax and 6,000 as the DTL. My provision for tax is 18,000, which is showing as a current liability. My non-current liability is showing as DTL of 6,000, and my PP is carrying at a value of 8,000. So my current tax, which is 18,000, my temporary difference, which is 20,000, which is between the tax base and the book base. My tax expense is 24,000, which is summation of the current tax and DTL. DTL is 30% of my 20,000, which is 6,000. My PP is carrying at a value of 8,000. So we'll quickly move to the next slide and see the impact in the next year, which is year two. Okay, so we are in the year two. So let's just quickly look at the facts here. So in year two, what's happening? My PBDT, I'm assuming the same as 1 lakh rupees. My income tax depreciation now, because we have already reduced 40,000 from my 1 lakh rupees. So which is my base is 60,000. 40% of 60,000 is 24,000. So this is the 40% of 60,000, 24,000. My PBT is 76,000. Now my tax is 25%. So 25% of 76,000 is 19,000. We'll calculate the tax base and book base. So my book base is, so my tax base is 60,000, which is the opening balance, minus 24,000 this year. So which is my tax base is 36,000. My book base was 80,000 because 20,000 was deducted last year and 20,000 is going to deduct this year. So my book base at the year end is 60,000 this year. My temporary difference is again, we have to create the detail because my book base is more than my tax base. So my book base is 60,000, my tax base is 36,000. So my temporary difference is 24,000. Now we have to look comprehensively here because we already have a temporary difference of 20,000 last year. So this year my temporary difference is 24,000. So which means that there is an increase in the temporary difference by 4,000. So whatever DTL we have to create on this 4,000. So year one DTL was created on 30%. Now we have to so this is a typical scenario wherein we have to do the remeasurement because we have a rate change impact here. So what we are going to do first, we are going to do remeasurement for the opening DTL. So remeasurement of the opening DTL due to the tax rate change. So my opening DTL was 30% of which is 6,000. Now in the year two, my tax rate is 25,000. Has applied the opening DTL should be on 20,000, which is my temporary taxable differences, on which I applied my last year DTL at the rate of 30%. Now we have to apply the same at the 25%. So which means that my DTL would be reduced from 20,000 to from 20,000 on the 30%, it is due to 25%, which is my 5,000. So my DTL will be reduced from 6,000, which is the opening DTL, to by rupees 1,000. This is a reduction in my DTL. But we also have a temporary difference of how much? 4,000. So we have to create the DTL on this 4,000. So calculate the DT on this 4,000 at the rate of 25%. We have to create the 1,000. So what's happening here? There are two scenarios. One is the DTL reversal to the extent of 1,000, and then we have a creation of the so one is the DTL reversal here. We have a DTA creation as well, 20 of 1,000, because my temporary difference has increased from 20,000 to 24,000, and hence I have to create the DTL on this 4,000. So my DTL will be increased from existing whatever it was carrying in my books by another 1,000. So there's a double effect. My DTL would be increased by 1,000 and it will be reduced by 1,000. It will be increased by 1,000 because my DTL, because my temporary difference increased by 4,000 and hence my DTL will increase by 1,000. But because of the rate change, there is a reduction in the DTL to the extent of 1,000. So what is the happening? What is happening now? So my total tax expense would be my current tax, which is 19,000 here, which is being shown here, 19,000, and then deferred tax liability, which is 1,000, which is nothing but this 1,000 here. So my total tax expense is 20,000. Now, but when we book the entries, what will happen? We have to create three entries here. One is the we have to create the entry for the provision for current tax, which is the PNL to my provision for tax, which is 19,000. Then we have to create one DTL, which is the PNL to my DTL, which is to the extent of this 1,000 rupees, which is a new DTL that is going to create it. Then we have to reverse one DTL because we already have a rate change. So we are going to reverse the DTL, deferred tax liability, to PNL, which is to the extent of 1,000, which is this component. So which means that my total charge to the P&L would be 19,000 only. So how this is going to get presented in the financial statement? Let's move to the next slide. Okay. So in this slide, we are going to present the financial statement for the year two. So we are saying that profit before tax is 80,000. My current tax is 19,000. DTL created 1,000. DTL reversal minus 1,000. My profit after tax is 61,000. My provision for tax is 19,000. Non-current tax liability, which is 6,000. Opening amount plus 1,000 additional creation minus 1,000 reversal because of my rate change. So my closing is still 6,000. My PPE carrying amount is 1 lakh minus 40,000, which is 60,000. So My current tax is 19,000. Temporary difference is 4,000. DTL created on it 1,000. DTL reversed because of my tax differences, rate differences. Tax expense is 19,000 and my carrying amount is 60,000. So this is the last slide in the examples. So with this, we come to the end of this slide. So we'll move to the last slide, which is the closing slide. Okay, so this is our thank you slide. So again, I would like to thank all my viewers and subscribers for watching this video till end. So it's my continuous endeavor to bring up with these kind of presentations that help the users to recap their understanding on the IND AS. And this was typically a scenario wherein we come up with the two portion or two presentation for a single IND AS, because we thought that it is very much of use when we present this IND AS with the help of some examples. So my request is to please cascade this video to all the people who want to understand the IND AS in detail. You can cascade it to any person who is actually preparing for their professional exams. And please help us with your feedback in the comment section. And we are, definitely want to improve upon if at all we get some feedback. And we are going to come up with the next IND AS very soon. Thank you and have a good day.